What if I told you that the single best performing stock in the entire S&P 500 this year, not Nvidia, not Microsoft, not any flashy AI software name, is a storage company? And what if I told you that analysts on Wall Street are now screaming price targets of $2,000 per share and beyond, while most retail investors haven't even heard of the Thesis yet? Stay with me, because by the end of this video, you are going to understand exactly why SanDisk, ticker SNDK, has quietly become the landlord of the entire artificial intelligence data world, why every single price target we set on this channel has been hit with surgical precision, and most importantly, where this rocket ship is actually headed next. You are watching Smart Stock Sam, and this is the most important storage story you will ever hear. Let's decode it. To truly understand the magnitude of what we are witnessing, you have to first appreciate how violently the paradigm has shifted. For years, decades really, Wall Street treated memory and storage like a boring, dirty commodity. You bought it low when PC sales were slow, you sold it high when demand spiked, and you moved on. Cyclical, predictable, forgettable. That world is completely and utterly dead. We are in a brand new era, and the market is only now beginning to price it in. Think about it this way. You can build the most powerful AI supercomputer on the planet, stack it ceiling high with the best graphics processing units money can buy, and still have absolutely nothing if you cannot feed data to that machine at lightning speed. Storage is not an accessory to artificial intelligence. Storage is the bloodstream, and SanDisk has become the heart. The year-to-date return on this stock as we enter the week of May 11, 2026, is 495%, nearly 5 times your money. In a market crowded with artificial intelligence hype, it is the storage company sitting at the very top of the leaderboard. And the question that every serious investor needs to be asking themselves right now is the real move already over, or are we still in the early innings of something truly historic? Before we answer that, let's take a moment to give credit where credit is due, because the readers of this channel who stayed disciplined are sitting on life-changing gains right now. In my May 1st video, when the stock dipped right after an earnings beat and every tourist investor was rushing for the exit screaming, "Sell the news," I told you exactly what was happening. That was not a breakdown. That was a mechanical clearing of a crowded trade. I told you to watch the $996 gamma flip level like a hawk. And what happened? That level was aggressively defended. The stock never even touched it. Psychological support held firm at the $1,000 floor, with actual lows holding near $1,048. Then the real move began. Once the stock shattered through $1,115 resistance on a massive 23.1 million shares of volume, the path was wide open. We hit the revised target of $1,200 and blew clean through it by May 4th, closing at $1,255. The map worked, the mechanics worked, and the thesis is working even harder now. So why is the business actually worth this much? The answer is hiding inside one set of earnings numbers that honestly made my jaw drop when I read them. Revenue came in at $5.95 billion, a 251% increase year over year. Let that percentage echo in your head for a second. 251%. But the number that truly rewrote the narrative is the non-GAAP gross margin, 78.4%. In the semiconductor memory business, where you would historically celebrate a 40 or 50% margin as exceptional, SanDisk is printing margins that would make software companies blush. We're talking about software-level profitability on physical hardware. That is the holy grail of investing. Wall Street expected earnings per share of $14.54. SanDisk delivered $23.41. That is not a beat. That is an obliteration. And the reason those margins are not going to collapse back to earth when the next down cycle comes is the most important part of this entire story. Could you imagine a scenario where one of the world's most critical technology companies signs multi-year, locked-in supply agreements with the biggest cloud computing giants on the planet, essentially eliminating their own revenue volatility overnight? That is exactly what SanDisk has done. And the number attached to it is staggering: $42 billion in minimum contractual revenue. $42 billion, not projected, not hoped for, contractually guaranteed, with $11 billion in ironclad financial guarantees sitting behind it like a steel wall. SanDisk has executed 5 of these multi-year deals with the world's top hyperscalers, the cloud giants who run the servers that power every artificial intelligence model you have ever interacted with. This is no longer a cyclical memory company living and dying by quarterly spot prices. This is a toll bridge, a landlord. Every single time an AI model is trained, every time a query is processed, every time data flows through the infrastructure backbone of our digital economy, someone is paying rent to SanDisk. That is the new business model, and it has permanently re-rated this company from a cyclical trader's toy into a structural, recurring revenue infrastructure giant. And it is not just the contracts doing the heavy lifting here. The institutional architecture surrounding this stock has been quietly building one of the strongest structural demand floors I have ever seen in 20+ years of studying the market. On April 20th, SanDisk was added to the NASDAQ 100 index. That single event triggered a wave of forced buying from passive index funds, giant pools of capital that don't analyze companies, don't debate valuations, they simply have to own the shares to track their benchmark. That mandatory buying never truly stops, because every new dollar that flows into index funds adds more pressure. Layer on top of that a $6 billion share buyback program, which is management putting their own money on the table and loudly declaring they believe this stock is still undervalued relative to future cash flows. And then consider this final number: 92.13% institutional ownership across 995 top-tier entities, including Vanguard and BlackRock. The smart money is not nibbling at this stock. They are aggressively restricting the available float. They are locking these shares in a vault and throwing away the key. When the sellers are few and the forced buyers are many, gravity works in one direction only. Now, even the most structurally sound investment in the world will have its moments of drama. And the week ending May 8th was a perfect masterclass in separating signal from noise. On Thursday, May 7th, shares fell nearly 5% to $1,339 after Bernstein issued a note warning about cooling spot market demand. I want you to really sit with that for a moment. Cooling spot market demand on a stock with $42 billion in contractual minimum revenue. The spot market is essentially irrelevant to SanDisk's current business model. It's like worrying about street parking revenue when you own the entire parking structure under contract to a Fortune 500 company for the next decade. To anyone watching without understanding the thesis, Thursday looked like the beginning of a collapse. To those of us who understood the structure, it was a gift, a textbook buy-the-dip accumulation opportunity. Friday, May 8th confirmed it violently. Shares surged 16.60%, closing at a brand new all-time high of $1,562.34. The market had spoken. Storage is the bottleneck, SanDisk is the landlord, and no analyst note about spot pricing is going to change that structural reality. Which brings us to the question you came here to have answered. Where does this go from here? We now have a clear path to $2,000 per share. In the near term, we are watching the $1,650 to $1,700 range. That is Bernstein's own revised target after their brief moment of doubt. The structural bull case from our analysis sits at $1,800, a level also flagged by fellow analysts tracking this same infrastructure re-rating thesis. And the street-high target, the big one, the number that Susquehanna has planted at the top of the mountain, is $2,000. That is the psychological wall that is going to define the next chapter of this story. Now, will this be a straight line? Of course not. But there is a specific technical setup developing right now in the options market that could accelerate the timeline dramatically. Here is what keeps me up at night in the best possible way. The options chain on SanDisk right now is what I can only describe as combustible. There are currently 9.75 million shares held short, representing over 10% of the float. These are people actively betting against a company with 42 billion in contracts and software-level margins, and they are deeply underwater. That alone is your short squeeze fuel. But the real accelerant is in the derivatives market. The put-to-call ratio is sitting at 1.45. Dealers who have sold calls are heavily hedged to the downside, and the moment we break through the $1,600 call wall, those same dealers will be mechanically forced to buy millions of shares in a rising market to rebalance their exposure. That is a dual-engine ignition switch. Shorts being forced to cover at the exact same moment that dealer hedging forces aggressive buying. If 1,600 breaks, the resulting move could be violent in the most profitable way imaginable. Here is your battlefield map for the week of May 11th. We closed at the record high of $1,562.34. Above us, the immediate resistance is the $1,578 classic pivot, followed by the massive psychological and options-driven wall at $1,600. If we clear $1,600 on strong volume, there is no meaningful technical overhead resistance between us and the Bernstein target. To the downside, the bulls need to defend $1,501. That is our first support pivot. Below that, $1,463 represents the medium-term trend defense. As long as we hold above 1,500, the bulls are in absolute control of this narrative. For the aggressive trader, the entry zone is the $1,515 to $1,540 range, buying near the 5-day moving average to position ahead of the 1,600 breakout catalyst. For the conservative investor, patience pays. Wait for a retest of the 20-day simple moving average and prior resistance-turned support in the $1,410 to $1,425 zone. Lower risk, lower stress, still structurally compelling. I know what some of you are thinking right now. The RSI is sitting at 75.65. That is overbought territory by every traditional definition. In any other market, in any other cycle, I would be right there with you raising the caution flag. But here is the RSI dichotomy that changes everything. SanDisk is not in a normal cycle anymore. When a company successfully transitions to recurring revenue with software-level margins and a $42 billion contractual moat, traditional momentum oscillators will likely remain historically elevated for extended periods. You cannot apply 20th century technical tools to a 21st century paradigm shift. The risk is not that this stock is overbought. The real risk is that the market has not yet fully priced in what $42 billion in guaranteed contracts actually means for the long-term earnings power of this business. 78.4% gross margins, $42 billion in contractual revenue, 92.13% institutional ownership, $6 billion in active buybacks. When you lay those four numbers side by side, the conclusion is not complicated. The path of least resistance for this stock is up. The final verdict from Smart Stock Sam is this: the thesis that SanDisk is becoming the undisputed landlord of the AI data world is being validated every single day by the tape. The structural shift to new business model recurring revenue is complete. The margins are real, the contracts are real, the institutional support is real, and storage has finally, definitively been recognized by the market as the critical bottleneck that the entire artificial intelligence revolution runs through. The trend is your friend. Do not try to be a hero and short a parabolic move that is backed by $42 billion in contractual guarantees. Before I wrap up, I have to give you the disclaimer that every responsible investor deserves to hear. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything discussed here is purely for educational and informational purposes. All investing carries risk, including the potential loss of principal. Past performance, even a 495% year-to-date return, does not guarantee future results. Please consult with a qualified financial professional before making any investment decisions. Do your own due diligence. Understand your own risk tolerance, and never invest money you cannot afford to lose. Now here is the question I want you to sit with and drop in the comments below. If SanDisk's $42 billion contractual moat keeps expanding and those software-level margins hold, is $2,000 actually the ceiling, or is it just the next floor? I genuinely want to read your thinking on that. If this analysis helped you see this story from a different angle, smash that like button. It tells the algorithm that this kind of deep fundamental work is worth surfacing to more investors. And if you are not yet subscribed to Smart Stock Sam, hit subscribe and ring that notification bell so you never miss a tape update on one of the most important infrastructure stories in the market. Finally, if this channel has added real value to your investment journey, consider showing your support through YouTube's Super Thanks feature. It goes directly toward keeping this independent research free and available for every investor, regardless of the size of their portfolio. I will see you at the next level. Stay sharp, stay disciplined, and I will see you in next update.